Hello, I'm Brian Resnick. I'm a senior investment strategist with AllianceBernstein, and welcome to Uncommon Capital, a podcast where we explore the far corners of the private markets and learn important lessons from professional investors. Today on Uncommon Capital, I'm joined by someone who sits right at the intersection of education, innovation, and the rapidly evolving world of alternative investments. Aaron Filbeck is a managing director and head of content and community strategy at CAIA, where he leads global content strategy, product development, and practitioner education for one of the most influential organizations in alternatives today. Aaron holds a BS with distinction in finance and a master's of finance from Pennsylvania State University, and he has quite a few letters next to his name. Aaron is a CAIA charter holder, a CFA charter holder, a CFP professional, a CIPM certificate, and he holds the FDP designation. Aaron, thank you so much for joining us today.
It's great to be here.
You know, Aaron, I want to start by talking a little bit about your personal journey. So a lot of people that we have on the podcast started off in a variety of different fields or different academic studies and then ended up in the investment management business. But when I look at your background, your academic background even, it seems like you've always had an interest in investment management. So where did that come from? And really, where did that passion get started within you?
Yeah, absolutely. Well, let's go back to when I was 5 years old and we can work our way up from there. No, I've always been interested in this field. I loved numbers growing up. And when I started in college, I pursued a lot of quantitative disciplines. So I love physics, I love math, statistics, and I was trying to figure out what I wanted to do. Went down the path of wanting to be an actuary at one point, and now I realize that would have been a terrible fit for me from a career perspective, but that kind of maneuvered my way into the finance realm, and I've loved it ever since. I just love solving puzzles. So whether that's through my academic pursuits, my practical pursuits early in my career, and now here at CAIA. So it's been a ride.
So basically, you like solving problems. It's interesting because we talked to a lot of engineers who ended up in this business that have a very similar backstory. Now, what I really think is interesting about you as a guest is that you educate the most sophisticated and those that are new to alts. And I think one of the advantages we have is that we can kind of start at the ground level. I'd love to understand how you think about what defines an alternative, because that definition has changed so much over the past couple of decades. What do you think makes something an alternative, and how has that definition changed over the past several years?
Yeah, well, I think there's a couple of different ways you can define alternatives. One is the easiest, which is basically everything that's not traditional, which is not helpful at all when it comes to defining this space. You can do the whole it's not stocks and bonds, it's everything else. So we think of alternatives in kind of the four main food groups, if you will. Private equity and all the different flavors of private equity, from early stage venture, growth, and buyout. Private credit, all the different flavors of private credit as well. Cash flow-based lending, asset-based lending, specialty finance, and so on. Hedge funds and all the different hedge fund strategies that fall under that category of equity hedge, macro managed futures, event-driven, relative value, and so on. And then real assets, infrastructure, real estate, commodities, natural resources. And then you get into some of the stuff like artwork, intellectual property, cryptocurrency, that kind of swim around the periphery of those four main categories. And how that's evolved is, as you just asked, is that mix has changed over the past 20 to 25 years or so. When CAIA started in the early 2000s, alternatives and hedge funds were pretty synonymous with one another. The universe was somewhere around 5 to 6 trillion in assets under management, and the majority of that were hedge fund strategies. You kind of had a little bit of private equity on the periphery, a little bit of private credit, some real assets, particularly in real estate, that made up that 6 trillion in terms of institutional quality alternatives. But if you look today, alternatives represent about 25 trillion in assets under management.
Wow.
So we've had about a 5x growth in this industry over the past 20 years. And then the composition of that 25 trillion looks really different than what it was in the early 2000s. So today, private equity is by far the largest component of that 25, sitting around 11 trillion in assets under management. Hedge funds are still there. They're around 5 if you include liquid alts in that mix. Private credit is its own industry now. It wasn't 20, 25 years ago. Real assets, and particularly outside of real estate, when you look at things like infrastructure and natural resources, have also grown quite considerably. So this kind of alternatives misnomer that we've introduced to this industry is somewhat confusing because you've got all of these different underlying strategies that operate differently. They sit in different parts of companies' capital structures and so on. So it's been quite an evolution from an industry perspective.
So the catch-all term of alternatives is slowly becoming less relevant, it sounds like, as these different types of what's considered alternatives grow.
I think that's true. And ironically, this is coming from CAIA, the Chartered Alternative Investment Analyst Association.
Yeah, you're going to have to change your name.
We're going to have to change our name or something.
Amazing. And, it seems like so much of the conversation these days in alternatives is around private markets. And I think, when we speak to some people on the podcast, it's almost become synonymous with private markets. Well, why do you think that is? Is it just because of the size, or have they been effective in terms of the outcomes that folks are looking for with alts?
Yeah, it's a good question. And again, if we go back 20, 25 years ago, hedge funds and alternatives were synonymous with one another. So I do think there's kind of this industry conversation that changes the definition. There's a lot of corollaries that are made based on where the fundraising is taking place, where the assets are taking place. And again, if you look at that 25 trillion, roughly 20 of it is in private markets. So it makes sense that the conversation has been more synonymous between private markets and alternative investments. Now, over the next 10 years, who knows what that makeup will look like, but hedge funds are still an important component of this industry, but it's now a minority relative to all the other stuff.
Obviously, there's a very diverse set of alternatives, and since they have different outcomes and different types of investments, it's hard to make a blanket statement, as it were. But in general, for those that are newer to alts or haven't even embraced alts, why would someone consider using something that is considered an alternative, whether it's private equity or private credit or hedge funds in a portfolio?
I would answer it the same way why you would consider any investment, and that is diversification. It's not that alternatives themselves are the saving grace of your portfolio. And in fact, there are some alternatives that you shouldn't own, depending on your objectives, your constraints, your preferences, or your client's preferences. But you should be able to consider the entire opportunity set that's in front of you. And so I would always recommend anyone to look at public equity, public fixed income, private equity, private credit, all of these options, and say, what is the best mix of all of these different investments that's going to deliver on my client's objectives? And keep it as simple as that. And then it kind of solves itself as you start to consider what the actual tools and the ultimate strategies you allocate towards. That is kind of solved because you've got the higher level conversation that you've already established.
So it's not that everybody needs alts or that even every alt is appropriate for every investor, but it sounds like you're advocating for, and it makes sense given your role, educating on alts if you're an allocator or an investor to decide whether or not, different types of alternatives make sense.
Yeah, and it's funny because, sometimes we'll go to conferences or we'll interact with advisors or other investors, and they say, Aaron, why do I need to get educated on this stuff? I'm never going to use it. And my response to that is, well, you need to know when to say no. You need to know whether it's a wholesaler or a product provider comes to you and says, look, I've got this really great strategy, and you can't determine whether or not this is an actual fit or not. You need to be educated in saying no as much as you are saying yes. And so being well-informed, regardless of your decision to allocate to alternatives holistically or a particular part of alternatives, it just makes you a better investor and it makes you a better fiduciary for your clients.
I want to shift gears a little bit and talk about implementation, actually thinking about putting these things into portfolios. And I've read a lot of your work, and we know historically that even institutional investors have historically held alternatives as a separate allocation outside of the traditional portfolio, but it looks more and more like, and particularly your organization is advocating for a more integrated approach. So take me through kind of your thoughts on how to allocate alternatives, and I'd love for you to touch on this concept of total portfolio allocation that I know you and CAIA have been advocating for.
Yeah, so I think there's a couple of things there, so I'll try to hit on all of them. One is this idea that alternatives should sit in some separate isolated bucket from the rest of your portfolio. And that might have been the way of the world 10, 15, 20 years ago. But today, as this industry has grown and there are new sub-strategies that are available for clients, I think it's a much more impactful way to build a portfolio to focus more on what's the underlying risk exposure of these different strategies. And so private equity and public equity at the end of the day are equity ownership in companies. Credit you're making loans, and that can be done broadly syndicated in the public markets or in the private markets in a more one-to-one capacity. Real estate has public and private options available. And so when you start to break down the actual scary labels of what alternatives are, or the title of the product that might exist, really getting into what is the incremental add to the portfolio, then you kind of break down those silos of, I've got my traditional stuff over here and then all this other weird esoteric stuff over here. So taking kind of a look through into the underlying risk exposures is step number one. So to your question on total portfolio approach, this is something that we've been on this journey with on the institutional asset owner side, really for the past couple of years. And there's a handful of asset owners, again, institutional, so not wealth oriented, but I think that there's some lessons there for the wealth channel. Institutional investors who are now starting to think through breaking down those labels, having a more holistic approach to how they manage capital. And then this whole concept of competition for capital, which gets into the implementation side of how you get alts in a portfolio. And the idea behind TPA when it comes to implementation is that you now have assets that are all competing for that marginal dollar in the portfolio. So rather than saying, well, I've got to fill up my 10% bucket to private equity and my 15% bucket to public equity, instead I'm going to say, I've got this opportunity in front of me, whether it's venture capital or it's private credit or some opportunistic infrastructure project that's there. And now I'm going to compare that to the overall portfolio and say, does this actually add value to the overall portfolio? Is it getting me closer to my goal? Is it improving the risk return profile? Or am I better off with some other deal that's out there? Or am I good with what I've currently got? And I would recommend any wealth manager who is just starting on this journey that perhaps they've only got public equity and public fixed income and are fully 100% liquid and traditional, look at alternatives in the same way. Look at one strategy at a time and start to compare that against the rest of the portfolio and say, is this actually adding some incremental value to the portfolio or is it not? And I think that framing might help you rather than say, well, I've got this 20% allocation that I've got to fill. So TPA is historically been very institutionally driven, but I think there's some concepts that we've written about at CAIA that can be applicable to the wealth channel as well.
That's great. So what I'm hearing is maybe a good first step for advisors, instead of thinking about carving out an asset allocation to alternatives, is just thinking about integrating it into their current asset allocation. And then as you advocate with the competition of dollars, maybe even moving a little bit beyond those rigid buckets and thinking more about outcomes, which sounds like similar to goals-based investing, but perhaps a little bit more scientific in a way, because you do talk about measuring things like illiquidity, yield, premiums, the types of things that are additive to a portfolio. And would you say that it would make sense to even think about portfolios on those dimensions as opposed to, let's say, how much you have in each asset class?
Yeah, I think goals-based investing is a philosophy at the highest level. And so when you talk about things like retirement savings or generating income in retirement or whatever the case might be, that's when you start to get into, well, I've got more of an income orientation or I need some inflation protection. And all of these different objectives are agnostic to what you actually own in the portfolio. Then when you get into the implementation is when you start to take this competition for capital type of framework or implementation. And then you can start to think through, okay, well, how does this infrastructure project contribute to my income orientation and my inflation protection orientation? Or if I've got a growth orientation, how does this private equity strategy improve the profile of the overall portfolio? So it is kind of building upon that philosophical goals-based investment approach to investing. But to your point, it does kind of get a little bit more tangible in terms of how you look at illiquidity and drawdown risk and all the quantitative metrics that we like as investment professionals.
Do you think the advent of evergreen strategies and wrappers like the interval fund are making this more accessible? And is there anything that you worry about as it relates to this democratization of alts?
Well, I think the evergreen structures that are out there are valuable. It does allow investors who historically couldn't access some of these strategies to access these strategies. There's a lot of operational efficiency, whether it's simple things like having a ticker or 1099 reporting here in the US. There's a lot of benefits to opening up these vehicles for investors, and particularly for advisors who don't have one client like an institution. They might have 400 households that they're looking after. And so thinking about how you offer all of this, but with scale for your clients, there's all sorts of benefits that come from the evergreen structure. What I think I worry about, and this is kind of the old innovation cycle that happens where, whether it's technology in the dot-com, boom and bust, where you're kind of over-investing in some of this stuff, and then there's this drawdown that takes place, but then you've got things that survive. And I'm just increasingly concerned about, more product comes to market, more asset managers are building these products, and not all of them are built the same, and not all investors are educated the same. And so what happens when people start to run for the doors, when things get challenging? But also, more importantly, what happens to those strategies that have a mismatch between what's underlying in the portfolio and then what the vehicle is supposed to provide as well? If you've got a fully illiquid strategy, but you've got a semi-liquid fund structure, when does that start to create a tension with redemptions and liquidity that's required as well? So I think there's maybe a meta commentary on where the industry is headed. It's still very small, but as we continue to ramp up, we're likely to see some issues that come to light. And then on the more specific fund side, it's what happens with the underlying strategy versus the vehicle itself.
So what I'm hearing is, number one, there's an extra dimension that the manager has to manage in terms of the liquidity of the vehicle if it's not a drawdown, if it's something like an interval fund. And the risk is that some of these managers are less successful than others. And so if I kind of dig into that, it sounds like manager selection is going to be critical in general in this space, but even more critical as we think about these more democratized vehicles.
Manager selection, certainly, and manager selection is so important in alternatives more broadly, the umbrella term here. But the dispersion of outcomes in even the drawdown fund space is wide. Maybe it comes in a little bit in the evergreen fund space, but I think still incredibly relevant. The other thing I'll say is I think it's important to set proper expectations. If you've got managers that are allocating to a more liquid sleeve or they have to compromise on the strategy, you should know that and you should be able to articulate that, the manager to the advisor and the advisor to the end client.
Interesting. And so I guess, if manager selection is critical, are there any particular dimensions that you really think an advisor, an allocator should look at when thinking about selecting a manager?
Maybe the simplest answer here is to look at what the strategy is providing and does that liquidity profile actually make sense for the vehicle. So, private credit or core real estate or, high quality infrastructure that are more cash flow generating, higher quality assets, maybe a little bit more liquid, although illiquid in nature, but a little bit more liquid might make more sense for these semi-liquid types of vehicles. But when you start to get into long dated venture capital or, really concentrated strategies that are maybe even in the public markets, just like we saw in the mutual fund space, you've got to be able to acknowledge that yes, that strategy might make sense, but the vehicle's liquidity profile might prevent the manager from executing upon it. So I think just taking a look and intuitively, you don't have to do this quantitatively, think about where are the cash flows for this particular strategy and how does that line up with the semi-liquid if I were to redeem or my peers next to me were to redeem.
Amazing. So, one of the things that I want to talk to you about, because, we often think about, and you said this a few times, educating investors, educating advisors. You've been involved and at the forefront of educating on complex financial topics. What do you find works best and doesn't work as it relates to speaking to folks, maybe for the first time, about complex investments?
It is important to highlight education, but when I think about the struggles in alternatives, there's three levels to this. First is the very foundational level. What are alts? The question you asked at the very beginning of this, what are alternatives? How are they different from what you see in the traditional market space? What considerations should I think about when starting to make those allocations for the very first time? So that's number one. Number two are the actual asset classes and the strategies that are present. And that requires a deeper level of understanding and getting into, well, how do I compare cash flow-based lending versus asset-based lending? And what's the difference between venture capital and buyouts and growth? And how does this all kind of differ? And how do managers add value within each of these strategies? And that manager selection conversation, how should I think about that? And what drives some of those different returns? So that's number two, the more asset class or strategy level education. And then the third is the implementation. So how do I take this knowledge of, okay, I understand this is different. I understand there's considerations. Now I understand the asset classes and the strategies and how the manager adds value. How do I actually go from this knowledge and actually put it into practice? There's all sorts of other ways you can get educated about this. On one hand, is the formal education. So that's certification, that's going through courses, that's getting your CE credits if you are a CFP or IWI certificate holder. And we do all of that. That's getting kind of the industry knowledge across and contributions from the entire industry to understand these asset classes and how they differ from traditional, and walking away with at least a good framework and foundation for these different strategies. The other side of this is that implementation, and we can certainly do some of that, but then there's kind of the on-the-ground engagement, and we can do some of that through conferences or events, but also it's asset managers that are engaging with advisors and clients and really sitting down. And to that experimentation comment, how do I start? Like, let's talk about this one particular strategy and how does this actually fit in the portfolio? And so how does our strategy differ from others? And it allows advisors to ask better questions of those asset managers. So it's a couple of different dimensions. It's the three levels of education, but then how do you actually do it? And it's formal to, hand-to-hand combat, if you will.
One of the other things I wanted to ask you about is, as we think about alternatives and, the changing landscape, do you fear that it's getting crowded out? We do hear this from advisors of, so much money is chased alternatives. Is that a fear of yours?
That's a complicated question. Maybe a couple of ways to answer it. So alternatives, that 25 trillion that I mentioned is roughly 20% of AUM. So when you take in the long-only space, public equity, fixed income, money markets, whatever the case might be, alts represent 20% of the AUM. Alts represent about 50% of the industry's revenues. And so if you think about that for a second, very small portion of the industry is driving the growth of the bottom line of asset managers. And so I think what I'm maybe less concerned about, I'm less concerned about crowding out because it's such a small AUM size, but I do think the incentives are pretty clear when you start to put some of those numbers down. And so I will not be surprised when you start to see more product come to market. And there's some really, really good, sophisticated asset managers that put out great product. They're thoughtful about how they construct vehicles and so on. But as more and more attention is put on this space and the revenues are certainly there, you'll have more product that comes to market. And inevitably, you're going to have blow-ups and clients who sell at the wrong time and products that are not constructed the right way. And so I think I'm more worried about that side of the equation rather than, is there too much money in alternatives?
More about the proliferation of products and getting back to your point earlier about manager due diligence being so critical in this particular space, whether it's the product specific or the manager more broadly. What alternatives do you think are getting too much attention? And are there any alternatives that you think aren't getting enough attention today?
Well, I think that the alts that are getting attention the most, private credit. I mean, you cannot go to a conference without private credit being front and center for participants, and people eat it up. They still want to hear about private credit. There's so many private credit managers that are out there. And so if we're just going on pure headlines and attention, private credit is where a lot of the headlines and attention are. Now, private credit's only $2 trillion in AUM if you take into account the asset-based lending side as well. So of the 25 trillion of the overall pie, it's still relatively small, but there's a lot of attention that's been put on the private credit space. Underexposed, and maybe there's two areas that I think are interesting. Infrastructure, and I'm starting to hear rumblings of new product launches, especially in the United States, and then hedge funds. Hedge funds were kind of out of favor throughout the entire 2010s. They've had a couple of years of semi-decent performance, and the attention seems to be turning back to them as well. So obviously the big player, the private equity giants that are out there, they've had some challenges with exits and fundraising and so on. But if we're talking about extreme ends of the poles, it's private credit and maybe infrastructure and hedge funds.
Do you think there's a reason that credit has been more appealing for investors or has been more easily adopted by some of these investors?
Well, I think there's a couple reasons. One, it's easy to understand. I mean, if I try to explain private credit simply, I'm giving you a loan. And the difference is that it's a investor giving a company a loan as opposed to me giving you a loan. So pretty simple to explain to clients, by and large. Second, it's an income asset. I think people like the income component of private credit, and you get some cash flow right away from investing in these loans. And then third, that's where a lot of the evergreen and semi-liquid fund innovation has been. And I think that's because of the cash flow component that you see with private credit and the semi-liquid nature of these vehicles. So it's kind of just been the best of all worlds from an industry perspective.
Yeah, amazing. Thank you for that. If you think about alts, I mean, what really excites you in today's world of alternatives?
What excites me about alts today is the pace of innovation that's taking place. And whether we're talking about new ways of accessing through secondaries or it's the semi-liquid evergreen structures that are available, that is very exciting to learn more about. I also think this whole, and we've talked a lot about this at CAIA, but the convergence of public and private coming together, and people no longer viewing the private equity part and the public equity part as separate things. And the portfolios have kind of led the conversation, but now the product is following as well. And so you've seen all these partnerships between GPs and traditional asset managers that are launching strategies. So that's exciting to see. We'll see how it goes. Again, as I said before, the vehicles continue to come, and so there's inevitably going to be some bad ones that come to market. But innovation is definitely interesting, and the way that people are allocating portfolios today is very different. The TPA conversation that we've had at CAIA has been really exciting to see people think more holistically about what they're trying to accomplish, as opposed to saying, I need this percentage in this asset class or strategy. So there's a lot to be excited about in this industry.
So many of us turn to you for information about alternatives. How do you stay ahead of what's happening in the alternatives world?
Well, it's funny. People turn to us. We turn to everyone else. So CAIA is in this really unique position where we have this community of 14,000 charter holders around the world in 100 different countries that are all sitting in different parts of the ecosystem. They're GPs, they're LPs, they're wealth managers, regulators, academics. And so we're very fortunate in that we can benefit from the collective wisdom of all of these different players. But it's also, coming on podcasts like this, it's going to conferences and just engaging with people. And we get to be the clearinghouse for the industry's views. We are kind of the industry body that is trying to help the industry in turn navigate this crazy complex world. And
so tell us a little bit about what you're working on today at CAIA. What are some of the things you're focused on, and how can other people find the work that you're producing? Yeah, well,
we're all over social media, LinkedIn, Twitter, I guess it's X is there. And we're putting out a ton of content. There's a lot that's out there, and the team that we have is constantly pumping out insights. Where we're focused right now is we've been on this 12-month journey as an association, doing a kind of a world tour, listening tour to different C-suite executives and investment professionals who are all trying to help us think through what does the next decade look like. We've been calling it this Vision 2035 journey that we've been on that sets CAIA's strategy as an association, but also what do we talk about? Like what is most relevant for the CIOs and for the asset managers? And there's been a couple of takeaways from those conversations that over the next 12 months, we're going to be sharing in long-form research reports and podcasts and videos and setting our content agenda. So
we've talked about so many great things today, from education, from thinking about institutionalizing or taking some of that institutional knowledge and bringing it down to the wealth channel. If there was one thing that you would want our listeners to take away from today's conversation, what would that one thing be?
Just experiment a little bit. I think if you are trying to understand this space, educating yourself is important, but I think trying and getting your hands dirty with one strategy or one way of understanding how an asset class works. Just getting started with it and not being overwhelmed with being overwhelmed, I think is important. So that would be my takeaway.
Well, Aaron, this has been an incredible conversation. I can't thank you enough for stopping by. I've learned a lot. I know our listeners have learned a lot, and I just want to thank you for your time.
Well, thanks for having me. I really appreciate it.
Thank you for listening to today's episode. Please rate, review, and subscribe on your favorite podcast platform. I'm Brian Resnick, and you've been listening to Uncommon Capital.